Here is a typical exercise that I've run many times to many audiences over the years, and it's the idea of having two boxes to choose from, where you have box A on the left has 4 marbles in it, and box B on the right only has 1. And you'll notice in this particular case they are coloured. There are 3 blue marbles and 1 red in box A, and a green marble in box B. Now you are given the opportunity now to put your hand in one box and one box only and pull out a marble. However, you cannot see inside the box. You simply have to go in and pull out a marble by chance. Okay, so you may pull out a blue, you may pull out a red. Now in this particular example here, if you put your hand in box A and pull out a blue marble, I'll give you $1,000. However, if you unfortunately pull out the red one, I won't give you anything. Or you can put your hand in box B, you know there's only 1 marble in there, you'll pull it out and I'll just literally give you $700. I then will say to my audience who'd like to put their hand in box A, and I might have a handful of people, very small number, put their hand up, and then I'll ask people, of all those people who want to put their hand in box B, and then I'll get the majority of the audience say, yes, give me box B, give me $700. Well, then I get everyone to put the marbles back in, so to speak, and I change the situation slightly. The boxes and the marbles remain the same, but the difference is now that if you pull out a blue marble, you have to give me $1,000, so you lose $1,000. But if you pull out the red, then this time it's good luck because you don't have to pay me anything. Or you just put your hand in box B, pull out the green marble, and just hand me and lose $700. And again, I'll ask all those in the audience, who'd like to put their hand in box A. I tend to get, a few people putting their hands up. I then say, who wants to put their hand in box B? Probably fewer. And then, of course, I'm still left with probably 75% of the audience who don't wish to participate and commit to the risk of course, losing money. And I sometimes joke, who'd like to keep their hands in their pockets, which, of course, most people in this particular case would like to do that. If we go back to the first example, as I mentioned, most people tend to go for box B. It's the give me money, there's no risk involved, there's just $700 to be had, I'll take it. However, unfortunately, I think to trade well and think the right trader's mindset, we need to be thinking the opposite, and I'll explain that in just a moment. And then the second situation, you face the possibility of losing money. It's probably a little bit more even now, but certainly there is a few more people who tend to go for box A, fewer go for box B, but again, from a trader's mindset perspective, I think we need to be thinking the opposite. Now let me take some time now and explain this. In the first situation, you face the possibility of having a positive outcome. There was $1,000 up for grabs, there was $700, but of course there was also risk of not getting anything. The two choices you had, boxes A and B, the two choices could be described as a risk and a certainty. The certainty was the green marble. 100% guaranteed you were going to make $700. The risk, of course, was the red marble. Yes, there were 3 blue paying out $1,000, but there was also the red, which meant you would have got nothing. Most people that I have shown this to, and I have shown this to thousands of people over the years in all countries, and a lot of different countries that I've spoken in, most people tend to go for the green marble. They avoid the risk. They go for the certainty. So when they are faced with a positive outcome, it's human tendency, it's human nature to go for the certainty and to avoid the risk. Therefore, when faced with a positive outcome, we tend to adopt a risk-averse behaviour. I would suggest one of the most important trading rules there are that has stood the test of time is to let your profits run. In other words, you enter a trade, it moves in your favour, you now have an unrealised profit. It's human tendency or human nature to sell that, to realise the profit, because we're so focused on making money. And we know that we have a profit sitting right there on the table right now, that we can close that trade, 2 minutes later it's all over and the money's ours. So we tend to go for the certainty when faced with a positive outcome. But of course, to follow that time-tested rule of letting your profits run, you need to accept a risk and take on more risk by allowing that trade to continue, because we hope it continues to move in our favour. And then the best traders will do something even further than that. Not only will they leave that profitable trade alone, they may commit even more money to the trade knowing that it's moving in their favour. So they in fact adopt even more risk in the trade, and they seek out risk when things are going well for them, as opposed to the human nature of perhaps avoiding risk. Now, in the second situation, we of course face the possibility of a negative outcome. The two choices were the same. You had the certainty and the risk. Most people tend to avoid the just handing over $700 and tend to go towards the, well, you know, I know there's blue marbles there which I have to pay $1,000, but there's still the chance of not having to pay anything. So if you think now to when you enter a trade and it moves against you and you're faced with a loss, it's human nature to leave that trade alone and hope that it returns to break even. We hope and hope and hope that it won't go any lower and we won't lose money in the trade. And again, because we're so focused on making money, the whole idea of cutting that losing trade now and closing the trade and goes completely against our primary aim, which shouldn't be the case, but our focus on making money. It completely goes against that. So the best traders, when they're faced with a loss, a losing trade, will close that trade. They will go for the certainty. They go for the certainty and don't wish to take on any further risk, so they avoid the risk. Most people tend to seek risk. I mean, it's human nature. Why hand over $700 when you can still break even? Okay, so why deny yourself that opportunity of breaking it? Let's exploit every single opportunity we have and see what happens. So that's very much a human tendency. Now, if you go over the probability and the statistics and say, look, over time, if you consistently pick $700 every single time you're presented with that, then you'd do okay. And I concede you could put forward an argument that you would do okay. But of course, what we're not intermingling into that situation is every second trade or worse may actually lose money. So you really need to follow the notion of letting your profits run. And when you have a profit, it needs to be as good as it can be. And when you have a loss, you need to be as small or minimize that loss as much as we can. And the other thing I talk about with this mindset and that simple marbles example is, again, a very human tendency that we have. And that is, we often sacrifice our longer term goals for shorter term pleasures or to avoid short-term discomfort. So cutting a losing trade is going to present us short-term discomfort. Well, we'll try to avoid that discomfort by not cutting the loss, by allowing the trade to continue, hoping that it breaks even. But of course, by doing that, we're sacrificing our longer-term goals, which of course is to be a consistently profitable traders for a long time. Well, of course, when we have a positive trade and we're in profit, again, rather than letting that profit run and seeing how far it can go, we sacrifice our longer term goals for short-term pleasures. And the short-term pleasures is, of course, within the next 60 seconds, I can close this trade and I've now got money. It's as simple as that. So we'll sacrifice our longer-term goals to really seek out those shorter-term pleasures.